Okay, I think we can resume. So before the break, we were looking at the sales values and the variable cost, and we calculated our contribution, as you can see here. Okay, so what is the next next cost element that we need to factor? What's the next cash flow that we need to factor? According to the
production.
The fixed production, okay? But please take note of this. This fixed production, they told us that is an incremental one. If it is an incremental one, meaning it is relevant, it is a cash flow. So, but if it is a general fixed overhead, it cannot come here because it's a non-cash flow item. Take note of that. Okay, so next we say fixed production overhead. Just say fixed production, okay? Fixed production overhead, right? So the fixed production overheads, we've been told in the question, varies with the demand units, isn't it? And what's the how to call it, the cost as at now? What's the cost as at now?
It's 25,000.
25,000. 25.
And it's going to increase by how many percent?
6%.
7%.
Hey.
6%, guys.
6%.
6%.
It's going to increase by 6% per annum. So that means we are going to do our calculation here. So in year one, what we're going to get will be equals, okay? The fixed production rate is what? What is given in the question? 25,000. So we just do 25 multiplied by, what's the rate of increase? Is 1.06, isn't it?
Yes, 1.06.
1.06. We close the bracket. We close the bracket. So we multiply that by the unit. We have our unit here, isn't it? Then we enter. Okay. Is that correct? Is that correct?
It's correct, but it's not to the nearest thousand.
It cannot be correct. How can we have our fixed production at 927,000 compared to 433,000?
I think it should not be multiplied by the units, huh?
Exactly. It should not be multiplied by the units. Okay. It's only going to increase per annum. So it's an incremental one, but it's not going to vary with the unit. Okay.
Increase by 1.06%.
Okay. So that will be 27 for the first year. So we take, for the second year, we take the previous year multiplied by bracket opens 1.06. We close the bracket, we enter, and we replicate. Is that clear, everybody? So you'll have 27, 28, 30, and 32. Correct?
Correct, yes.
Good. Now, after the fixed production overhead, what we should have should be our net cash flow. Okay, our net cash flow will be the contribution minus this. Okay, that's given us. Okay, contribution minus this. Can you see? Is the contribution C10 minus C11. Then we just replicate. So we'll have our net cash flow as 122, 143, 187, and 78. Are we all together? Yeah? So far, so good?
Yes.
Okay. Right. So, are we done with our cash flows? Is there anything that needs to come? Is there anything else that needs to come? Yes.
Yes.
Tax needs to come, and also the disposal proceeds also needs to come. They are all going to involve cash flows. Okay, the disposal proceeds will be an inflow and the tax will be an outflow. But then there will be something else. Okay, so let's read the question. Go back to the question. It says that, okay, the last paragraph. Checo company has a real cost of capital of 5.7 and pays tax at an annual rate of 30%. So we are going to calculate tax on these cash flows. So let's calculate tax. Tax at 30%. Okay, so the tax for year 1, when will it be paid?
In year 2.
In year 2. And the tax for year 2 will be paid in year 3, and so on and so forth. Okay? So we're going to start calculating our tax from year 2. So if we had tax brought forward that has not been paid, then in that case, that will be paid in year 1. So we say equals this multiplied by 0.3 as our tax rate. And we just duplicate. Okay? But then in year 4, we're also going to pay tax, but then it will be paid in year 5. Is that clear, everybody? So tax will be 37, 43, 56, and 23. Okay, are we clear, everybody? Okay, so far so good? Okay, let's read further.
Okay.
Yeah, let's read further. It said Treco company has a target return on capital of 20%. Okay, that's the target return on capital that will be used for comparison. Depreciation is charged on a straight line basis over the life of an asset. Okay, but did we consider depreciation here?
No.
Does taxman consider depreciation? Do they allow depreciation? Have any one of you experienced submitting your quarterly reports, quarterly tax reports?
Yes, as you said, the cash flow. The depreciation is not part of it. Oh? No, I don't think.
Yes, depreciation is not part of cash flow. That is true. Depreciation is not part of cash flow. That's one thing. The other thing is, if you are submitting your tax returns to GRA, for example, do they allow you to deduct depreciation from your profit? Do they allow you?
No, they don't allow.
No, they don't allow. Okay, they don't
Yes,
allow
because
you.
we have even learned that in tax when we are doing tax.
Oh, good, very good. They don't allow you to deduct depreciation. Why they don't allow you? The reason is if they allow depreciation, then people will pay less tax. People will pay less tax because depreciation you can manipulate with it. You can do it in anyhow. You could use a method that could, earn you a very high depreciation expense, which will reduce your profit and naturally will reduce your taxation. So the taxman does not allow depreciation, but instead it gives back. Instead of allowing depreciation, it allows what we call capital allowances. Okay, it allows capital allowances, and capital allowances usually will have a flat rate. Okay, in this question, the capital allowance that is given is 25%. So what capital allowance means is it is a tax credit. Okay, so it works the same way as depreciation. You calculate capital allowance just like depreciation, and whatever you have, you apply the tax rate on it, and you have it as a tax benefit. Tax benefit means you knock it off against the tax you are supposed to pay. Is that clear? Okay, so for those of you who have done tax already, then I think my job is done easily for me. Is that clear? That's the essence of capital allowance. So we've calculated our tax. This is the tax we are going to pay, but we need to deduct that from the tax we are going to get. That's the tax credit. Okay, is that clear? Our tax credit. So now, in order to calculate our tax credit or our tax benefit, we need to do a working. So I just say tax benefit. Then I'll just put in brackets. That will be working 3, isn't it? Yeah? That will be working 3, yeah? So just copy, come down. Then I have my tax benefit here, paste. Okay, and then that will be working 3 here. All right. So now, how do we calculate our tax benefit? We calculate our tax benefit as we are calculating. So we're going to calculate capital allowances. It's the same way as you calculate depreciation using reducing balance method. Okay, no difference. So we're going to do that, and whatever we have, we calculate our tax on it. Whatever we have, whatever capital allowance we have, we're going to calculate our tax on it, and then that will be our tax benefit. Okay, so we're going to have our working here. So the first column will be our years, and we will do our calculations on the next one. Okay, just to make it simple for you. So what I can do is, let me cut this off. I just paste it here so I can have more space. So this will be our year, this will be our calculations. And then the next column will be if we calculate our capital allowances, CAPALLOW, I'll abbreviate it. Okay, and after deducting our capital allowance, we'll have our WDV, our written down value. Take note, WDV, written down value, and then we are going to get our tax credit or our tax benefit. Our tax benefit will be 30% on our capital allowances. Okay, close this. Okay. Is it clear, everyone?
Yes.
Excellent. Right, so we're gonna align this to the right, and we're going to format it so that we wrap it. Right. So this is our tax benefit calculation. So it's going to be for how many years? What's our project lifespan?
4 years.
4 years. So everything will be based on 4 years. Why did we have the 50-year column there? Why did we add it there? Here, the 50-year, why did we add it?
Tax payment.
Because of tax. Tax we know is paid in arrears. Our cash flows in year 4 will have to pay their tax in year 5. That's why we included year 5. Okay, so, right. Capital allowances. Capital allowances are calculated on what? On assets, just like depreciations are calculated on assets. And there's only one asset that is given here. What is the asset? That is the machinery. And what's the cost of the machinery? The cost of the machinery is $250,000, and its useful life is 4 years, and the value is 5%. Okay, but when we are calculating our capital allowances, for your information, is the same as depreciation, but then it is the depreciation for the taxman. Okay, the taxman does not allow depreciation expense, but it allows you to take benefit of a tax benefit on your capital allowance. Is that clear? So now we're going to calculate it using our reducing balance method. So our first number we're going to start with will be the cost of the asset. And what's the cost of the asset?
250,000.
250,000. So our first calculation will be 250,000 to 3 multiplied by the rate, and the rate is 0.25. Okay. So we could in fact put the rate somewhere here. I'm going to put the rate here. I just say rate so that we can follow our protocols. I'll make this percentage, and it's 25. So here, I'm going to, all these things are going to be numbers. Let me take them to 2 decimal, no, just I'll round them up to 1 DP. So that's financial, round it up. Okay. So first here, we know our, how to call it, the value of our asset is 250,000. We multiplied by the capital allowance rate of 25%. Okay, and we're going to make this fixed. We enter. So that gives us 62,500. Sorry, 62,500 will be our capital allowance.
Mr. Vaughan,
Yes, sir.
where do you get 25%?
It's in the question. 25% is the rate for capital allowance.
It's in the question.
Last paragraph, yes.
The second to last paragraph, yes. It says it can claim capital allowance on a 25% reducing balance basis.
Yes, yes.
Can you see?
Yes, I saw it now.
Okay. So we're going to do our calculations here. Then we can put our capital allowance here. Okay. So now, what will be our WDV, our written down value? Our written down value will be what? What will be our
250,000 minus 62,500.
exactly? So that would be the 250,000. So let me just do it here. Let me just I'll just call this opening balance. This will be the balance brought forward. Sorry, I'll just call this balance brought forward. So that will be 250, 1, 2, 3. That will be 250,000. Then we take this 250,000, multiply by our capital allowance rate. We make it fixed, we enter. So that we have our 62,500 as our capital allowance, and our WDV will be the written out, the WDV is the same as what? The net book value. Okay? So we take our cost of the asset less the capital allowance, we enter. Okay? So our WDV at the end of year 1 will be 187,500. So what will be our brought forward?
187,500.
Same. So we say equals, we just click on that, we enter. Now, we can use our formula. We just replicate it here. If you replicate it, you will get 46,875. Okay, because that will be the written down value, sorry, the brought forward for year 2. Okay, the net book value for year 2, multiplied by the rate 25%, that gives you that. And if we replicate this formula also, our written down value at the end of year 2 will be what? 140,625. So we go to year 3. Year 3, what will be our brought forward? 146.25. We bring it forward. Okay. After bringing it forward, now we're going to do the same calculation. This 140,000 multiplied by 25% gives us 35,156 as our capital allowance, and our written down, our WDV will be this from that, 105,469. So that's at the end of year 3. But take note, we've been told in the question that the asset is going to cease to operate in year 4. That means in year 4, at the end of year 4, no asset. So everything will be sold. So if it is sold, then that means the WDV here at year 4 will be nil. Do you understand that? So now the brought forward here will be what? The brought forward will be what?
The brought forward will be the actual figure, 105,469.
Exactly. So we bring that forward. Now, what will be our capital allowance at the end of the year? We shouldn't have any written down value because everything is gonna go. The asset will be sold. So our capital allowance will be this value, okay, less the scrap value that we're gonna say, and the scrap value is 5,000. Is that clear, everybody? Because in year 4 we are disposing of the asset. So we say equals this minus, we say equals this minus 5,000. We end. So this is the full amount, and now if we deduct this, of course, less the 5,000 will give us 0. Okay? So at the end of year 4, the asset was sold, and as such, you cannot have it in your books. So that's why the value of the asset in year 4 is 0. Is this clear, everybody? Is it clear, everybody?
Yeah.
Okay.
Yeah. So,
yes, sir.
but still there is a difference of 5,000 and 4,000. Where are we going to credit that benefit, that non-depreciation? Or is it losses to us?
No. It's not a losses to us. It's an inflow. It's going to be part of our cash flow statement. But for now, when we are calculating our capital allowance, we know at the end of the year, at the end of the life of the asset, what do? You sell the asset off, don't you?
Yes, but like the cost of the asset is far more than what we sold it for. So we had a losses there.
Yes, naturally you'll definitely have a loss. An asset that has got an NPV of 105, if you sell it for 5,000, naturally you will. But then the thing is, if you keep it, maybe the maintenance cost will be very, very high. So that's why we usually ensure that once assets reach their useful life, we sell them off.
Okay.
Right? In this situation, of course, I agree with you. The scrap value is very small. The scrap value is very small, but unfortunately, that's it. Okay. Okay. So now, what interests us is our tax benefits. So in fact, I'm going to make them. I'm gonna color them right. So how are we going to calculate our tax benefits? Is going to be our capital allowances here that we have, multiplied by our tax rate, which is 30%. Okay, so our capital allowance, so our tax benefit will be 18, 14, 11, and 30. Is that correct? Because our tax benefit will be the tax rate on our capital allowances, on our depreciation amount. This is like our depreciation amount. Is that clear?
So why is it a benefit for us?
That's a good question. It's because you know, when you prepare your financial statements, you submit them to GRA or to the tax authority so that they can calculate your tax and you pay your tax. If you deduct depreciation, okay, you know, naturally, if we are preparing our financial statement, before we arrive at our profit, we usually deduct depreciation, don't we?
Yes.
If you take it to them, they add depreciation back. Okay? They add depreciation back. So they add depreciation back and then instead give you what? Capital allowance. So they will allow you to calculate capital allowance on your assets. Okay? Because they have prevented you from a reduction of tax as a result of the depreciation. That's why they're giving you back whatever tax benefit you are getting from your capital allowance. I hope that makes sense.
Yes.
Okay, excellent. So now let's go and do our tax benefits here. So tax benefits, just like we will pay our tax in arrears, we will gain our tax benefits also in arrears. Okay, so we're going to say equals. Let me see if I can use an automatic, how to call it, formula. I use the transpose. Okay, I can use the transpose.
Sorry, Mr. Fofana, let me just, how to call it?
You want to digest?
Just challenge you for, yes, like, okay, the depreciation, you know, the depreciation, they are asking us to add it back in order for us to pay more tax. And they give us a capital allowance. Why can we make a difference between the capital allowance they give us and the depreciation that we charge in our PL account?
Sorry, let me just get this right. I'll come back to you. Equals bracket opens transpose. I'm coming back to you very soon, don't worry. Transpose. We go back to this. Bracket closes. All that divided by 1,000. Right. Okay, so I'm going to make this fixed. I'm going, yeah, everything is fixed. No. Just trying to make it transpose just to give you an automatic function. No, the transpose is not going to work here. Okay, so we can just get it from there one by one. I just want to show you an automatic way of doing it, but it's like that function doesn't work here. Okay, Usman, I'll come to your question. So we say this divided by 1,000. Okay, and because they are in different, the layout is different, we cannot just replicate, so we have to do it one by one. I just thought I could do that automatically, but it's not allowing me to do that. Okay, so we go here, divided by 1,000. And we say equals the fourth year is this divided by 1,000. No, sorry, I've got 41, 42, that should be 43, isn't it? And then that one should be 44. Copy, paste. E43, E44. Okay, Usman, yes. Can you, what were you saying?
I said, the tax money, like the depreciation, it will reduce the amount of tax that the company is supposed to pay. But instead, they replace
Yes.
the capital allowances.
Yes.
And that capital allowances, for them to give it to us, is just to reduce the number of tax that we are going to pay. That's why they replace it with depreciation.
Yes.
They believe that, and always that is my concept, is anytime they give you capital allowance, your depreciation must be more than the capital allowance they are going to give you. So you are going to incur a losses there.
Well, not a question of incurring losses. At the end of the day, everybody wants to pay less tax. Go everywhere. People don't want to pay tax. So this is a practice in every country, well, that I know of. If they allow businesses to calculate their own depreciation and knock it off from their profit, at the end of the day, I mean, all businesses will pay less tax, and that's not in the interest of the government. That's why they disallow all depreciations. They disallow them, and instead they give you capital allowance, because that one they know that they'll use the same rate. For example, if they allow, let's say ABC Limited to calculate depreciation, ABC Limited could say their depreciation rate is 25%. Another company could come up and say my depreciation rate is 50%. Can you challenge them? You cannot challenge them. But if they say we're going to allow you, capital allowance, and the capital allowance rate, flat rate will be 25%, everybody uses that.
No depreciation.
No depreciation, no. Ask those who work at GRA, they will tell you. Ask those, even here they do it. They don't allow depreciation. Well, if you submit your something, they add it back. If you take depreciation from it, they add it back.
They add it back.
Yes, they add it back. They tax you, and then in return, they allow you to calculate your capital allowance. Okay, so let's move, please. Time is not on our side. So let's have our after-tax cash flow. So now we're going to calculate our after-tax cash flow. Okay, so our after-tax cash flow will be this cash flow, plus the tax benefit less the tax payment. We'll have 122 for this one. Let's duplicate it. That's it. So this will be our after-tax cash flow. Is that clear, everybody? So the net cash flow plus the tax benefit less the tax payment. So we'll have our after-tax cash flow of 122, 126, 158, 32, and 7. Then we have one more item that should come to our cash flow statement. What is that? There is one cash flow item that has not come. What is that?
That is the
disposal proceed.
That's the disposal proceed. And is that going to be an inflow or outflow?
Inflow.
Inflow, because this is the amount that we're going to sell our asset for, even though it's very small, but it's an inflow. So disposal proceeds. So when are we going to gain the disposal proceeds? In year 1?
Year 4.
In year 4, exactly, because that's the year we're going to sell assets. So we're going to sell our asset in year 4, and money will come in year 4. So that's 5,000, isn't it? Then let's have our total cash flow, total net cash flow. Okay, so the total net cash flow will be our cash flow plus our disposal proceed. Then that will be this. Is going to be the same for all of them, except the year when the disposal proceed is going on. So good. I hope you all understood what we've done so far. Okay, so now we have completed our cash flow statement. The next thing we need to do is we need to calculate our, what should we calculate?
Discount factor.
We need to calculate our discount factor. Okay, we need to calculate our discount factor so that we can discount the cash flows that are going to happen from year one onwards. And after that, we add all the discounted inflows and we deduct the discounted outflows from them. Is that clear?
Yes.
Excellent. Yes. So, but now, our problem is our discounted, our discount factor. What percentage are we going to use? Are we given? Are we given in the question?
No. Yes.
We are given. Okay, tell me. What's the rate?
I think 5.7.
No.
5%.
Let me read the paragraph. The paragraph says, Treacle Company has a real cost of capital of 5.7% and pays tax at an annual rate of 30% 1 year in arrears. It can claim capital allowances on a 25% reducing basis. General inflation is expected to be 5% per year. Treacle has a target return on capital employed of 20%. So what rate do we use?
Capital employed.
How about we add both ways? We have 11, like we add the 5 and then the other one, the 5.7.
No, we don't add them. Okay, simply please take note of this. And this is, I'm sure when you've done your master's degree or your professional courses, you'll see this into effect more. If you see something like this, they're talking about real cost of capital, inflation, cost of capital, and so on and so forth. They are trying to tell you that you have to calculate the nominal rate. It is always the nominal rate that that we use to discount our cash flows. Always the nominal rate. And what is given here is the real rate and the inflation rate. Okay, the real rate and inflation rate. You always use the nominal discount rate to discount your cash flows. Okay, it's not given. What is given is our real rate and our inflation rate. And the relationship between nominal rate, real rate, and inflation rate has been coined by one mathematician called Irving Fisher. Okay, which is the how to call it, the formula is called what? The Fisher effect. Okay, so we need to use the Fisher effect to calculate our nominal rate. Okay, so Irving Fisher has given the relationship between nominal rate, real rate, and inflation rate as 1 plus nominal rate is equals to 1 plus real rate multiplied by 1 plus inflation rate. Okay, so this is a scientific, the guy is a mathematician who coined this. So we're going to use the Fisher effect to do it. So I will say DF, discount factor, then I'll put in brackets working for, W4. Okay, so we're going to come to working 4. So this is working 3. We're going to do working 4. I'll do 4. Then I'll say BF using a fixer effect. Okay, which was by a scientist. Of course, all these mathematicians are usually scientists. It's called Irving Fisher, IRVING Fisher. It's by a guy called Irving Fisher. Okay, so what does this say? It says 1 plus nominal rate, I'll write it, 1 plus nominal rate, okay, equals 1 plus nominal rate equals 1 plus real rate multiplied by 1 plus inflation rate. Okay. So this is the formula by Irving Fisher, which calculates. So Rick tells the relationship between nominal rate, real rate, and inflation rate. Okay, so we should use this formula to calculate our nominal rate. Always take note, it's the nominal rate that is used to calculate our discount factor. So let's try to work this mathematically. Where are the mathematicians? So the first one, we have not got the nominal rate yet, have we? So we're going to say 1 plus NR. I'll just abbreviate it. Okay, so this is equal to what? What is 1 plus real rate? What is our real rate? Our real rate has been given in the question, isn't it?
5.7, I think, yes.
Okay, so our real rate is 1 plus, okay? 1 plus our real rate will be 1 plus, what is 5.7%? What is 5 point in decimals?
In decimals.
It is 0.05.
Hey.
0.057. 0.0.
0.0.
Is it not 0.0? Is it not 0.57?
5%. So you have to, if it was 50, then it can be 0.5. But it is 5%, so it's 0.57.
0.57 for your information. It's just 57.
0.057.
0.57. Excellent. So so it's what? Equals 1 plus 0.057. Okay. So that's that. Then multiplied by what? What is 1 plus inflation rate?
1 plus the inflation rate.
What is 1 plus inflation rate? What is inflation rate here?
The inflation rate.
It's given in the question, isn't it? Inflation is there.
5%.
Exactly. Inflation is 5%. So we say equals 1 plus, and what is 5%? 0.05.
0.005.
Hey, no 2 zeros there. 0.05. Okay? So now, mathematically, this will be what? Our 1 plus nominal rate will be equals to what? Let's multiply the two numbers. This multiplied by that. And that gives us 1.10985. So,
Please,
now,
can you please go back to? I was looking at. So okay. Yes.
Yes. No,
You
it's
say you
simple. Yeah, it's simple. According to our constant, according to our formula, 1 plus nominal rate is equals to what? 1 plus real rate multiplied by 1 plus inflation rate. Okay? So
Yes.
we're going to find them separately. We know that our 1 plus real rate will be what? 1 plus, our real rate is 5.7%. So that's the same as 1 plus 0.057. So that's 1.057. Okay? Multiplied by 1 plus inflation rate. Our inflation rate in the question is 5%. So 1 plus 0.05 will be 1.05, isn't it?
Yes.
Okay. So now according to our formula, we're breaking it one by one. 1 plus nominal rate is equals to 1 plus real rate, which is this, multiplied by 1 plus inflation rate. So if you multiply the two, it gives you 1.1095. Is that clear?
Yes.
Now, but what this 1.10985, what this is 1 plus NR, nominal rate. What do we want to find? We want to find nominal rate. So now what is nominal rate? What is nominal rate? Change of subject.
Yeah.
Simple change of subject. You need to be honest, to gain advanced accounting knowledge, you need to know a lot of mathematics, especially corporate finance. If you're doing ACCA, you will know at some point you'll be required to do some calculus. Okay, you'll be required to do some calculus, differential calculus in particular. Okay, but this is a very simple equation that we learn in primary school, don't we? So now, what is NR?
NR is minus 1 plus.
Hey.
No, it's going to be C52 minus.
One by one, please. Who wants to try? Nima?
Yes.
Okay, yes. So tell us, what will be our NR now?
Yeah, you have to move the one there to the other side. That will make it to be negative. Like the C52
Okay.
minus 1.
Okay, good. C52 minus 1. Because NR, in equation, if any changes position, their sign also changes. NR, 1 plus NR remains here, so no problem. Okay? We know that the 1 will go to the right side, so the sign for 1 at the moment is plus 1. Okay, so it's going to turn to minus 1. So therefore, we're going to have this minus 1. So that gives us 0.10985. Okay, so what is this 0.10985 if you turn it into percentage? 10.99%, and 10.99% if you round it up, is what? 11%. Is that clear? So our nominal rate or our discount rate we're going to use is what? 11%. Is this clear?
Mr. Fofana?
Yes.
What about if you put your NR is equals to minus 1 plus 1.10985 and then put the equals to there and put there 10, how to call it? Yes, 100985. will it not be correct?
If you say what?
Because like the mathematics here, the procedure is here is bit, we like you say that okay, 1.10985 minus 1 on a
Yes, that's
calculator.
what we have done.
Or you
Yes,
just put it there and minus.
that's what we have done. -1, and we express it into percentage.
Yes.
Exactly, that's what we have done. That's what we have done, yeah?
Yeah, it's okay.
Okay, is this clear, everybody? Sorry. Okay, so I hope it's clear how we arrive at our nominal rate. Our nominal rate will always be our discount factor. Sorry about that. We choke. Okay, so our nominal rate will be our discount factor. So we all know how we arrive at our nominal rate, yeah, everybody?
Yes, for me,
okay.
yes.
Okay, fine. So let's now go and calculate our discount factor. Simple, the way we have been doing it, we're going to use the same way. Okay, we're going to use the same way. So we're going to do the 3 decimal place. So we'll have 1, 2, 3. We're going to use the one up there. So we're going to say equals. Okay, are we together? One divided by what is 11%? 1.1 is 1.11, isn't it?
11 for the
Yes.
Is it not 1 divided by 1.11?
Yes.
Yes.
Raised to power?
Raised to power 1.
Okay, raised to power. I'll just use them here. Okay, then enter. So I'll take this to 3 decimal place. Okay, now we can just duplicate. This is faster. Correct. So our first DF is what? 0.901, 0.812, 0.731, 0.659, 0.593. I guess you are all experts in calculating discount factors now. So we're going to say workings and then we'll put 11%. 11% here to make it clear. Is that clear, everybody? We're all experts in calculating discount factors, isn't it?
Of course,
okay.
Yes.
Yes. So now we are going to calculate our present values, which will be the total net cash flow multiplied by our DF. We just duplicate. Finally. Okay.
Can you go back to this last one? You say?
Yes.
Yes.
So the last one is simple. It is the net cash flow multiplied by the discount factor.
The net cash flow. Okay. This way, 122.
Yes.
Multiplied by the
discount factor, 0.901, and so on and so forth.
Okay.
Okay. So now let's calculate our NPV. We do a summary here. So we do our total PV of inflows, PV of inflows, and we have our PV, total PV of outflows. I just change that to out. And we have our NPV. Okay. So our PV of outflows, sorry, our total PV of inflows will be a sum of all this, isn't it?
Total
That's
PV
what,
of
yes.
Yes.
So that's this, all this. Okay. We add all of them. And what about the present value of the total present value of our outflows? It's only one, isn't it? How much is it?
Yes, it's a 250.
250,000. And what's our NPV? Our NPV is the difference between 106,000. Okay, our NPV is 106,000. Okay, is this difficult?
It's not difficult, but it's too much.
Please try to get yourself familiar to it. You'll do this in the exam. You'll do something very similar to this in the exam. Okay.
Oh, no, this is too much.
Sorry?
Spend I said it's too much. You're going to spend a lot of time there.
Well, you understood it, but you know that it's very simple, to be honest. If you follow the steps, there is nothing difficult at all. You just have to follow the steps one by one. Okay. So now what will be your advice? We have NPV of 106,000. What will be your advice to management?
It's a positive NPV.
Mm-hmm.
So you're going to go ahead.
We're going to go ahead. Excellent. Excellent. We're going to go ahead with it. Excellent. Good. So now I'm going to leave you to do the B part and the C part. The B part is very simple. The B part is the calculation of the accounting rate of return. And you've been asked to calculate the before tax return on capital employed. That's the accounting rate of return. Okay, you do that as part of your assignment. The accounting rate of return, that's very simple. And we've been told to use the what? The average investment. So that will be the average accounting profit divided by the average investment. Okay, so you can do that. And the cash flow that you're going to use will be the before tax return on capital employed. Which one are you going to use? The before tax. Will it not be this one, yeah? So I'm going to call it so that you can find it easily. So I'm going to make it green. So this is the cash flow you should use. This is the before tax cash flow. Okay, so it's just a question of adding all of them, finding the average, and you divide it by the average investment. What will be the average investment?
Average investment.
What is the investment at start and what's the investment at the end?
250 was the investment.
250,000 is the investment at the start, isn't it?
Yeah.
Okay. And what is the investment at the end? The investment at the end is always the scrap value, isn't it?
Yes, the 5,000.
Okay. So it's going to be 250 plus 5 divided by 2. That will be your denominator. Okay. So please try that. Very, very simple. Then the C part will be to discuss the strengths and weakness of internal rate of return. So we're going to, so just spare me 15 minutes. We'll do internal rate of return, and then we will close for the day. And of course, we're going to close for this semester. Okay?
Yes. The B part is big.
Huh?
The B part, if you leave it with us.
No.
Yes. The B part, I've already answered it. The B part, we told you that you're going to use what? You're going to use what? The before tax cash flow. The before tax cash flow, I've already highlighted it green here. That's what you're going to use. So you're going to add all of them, average it, and you divide it by the average investment. The average investment is the investment at the start, 250, plus the investment at the end, 5. 250 plus 5 divided by 2, and then that will be your denominator. I've already answered the question now.
Okay.
Don't be scared. You've done all the difficult ones. Okay? So you will add all of them. After adding all of them, yeah? Okay? After adding all of them, that will give you your what? Your cash flow. So you have to take your depreciation from there. Okay? You have to take your depreciation from there. So you want us to do it? Actually, my problem is it's getting too late now.
Yeah, Mr. Fofana.
Yes?
But today is day, so
Mr. Fofana, I want to suggest if you can meet tomorrow at 5 o'clock, even if after all we are going to have 1 hour, so that we can wrap up. Because it's getting late.
No, we are done. We are done. There's no need to meet tomorrow. We are done.
Because if you observe, majority of the class, the members of the class are not in attendance. We have, I think, 10 or 9 people left attending the class.
I have 19.
I
have 19, according to my, usually it's not more than that. So I have 19. Actually, Karamo is their fault because I told them that we're going to have class. I've announced this for a long time. So even if you say tomorrow, it will be the same people who will be attending. You know that?
That is true. But the fact is, it's getting late here, and some of us have to travel from office to home, and it's already getting late.
Yeah, it's just like me. That's why I say, give me 15 minutes, we are done.
Okay.
Give me 15 minutes, we are done. I'm also in Carnegie at the moment. I have to go all the way to Bruce Lee. Let's sacrifice, Karamo. Don't even worry. This is learning, Let's sacrifice.
So, Mr. Fofana, the depreciation is going to be the depreciation for the whole 5 years, accumulative depreciation.
Yes, 250,000 minus 5,000.
Okay.
Okay. So if you add all of them, I think this is scaring you. Let's do it quickly, and then we'll look at NPV. Karamo, don't worry. So today is our last day, so don't worry.
I send you an exam exactly. Huh?
Something like similar.
This way I'm matured learning.
Okay, so I'm going to insert some space here. So we're going to do the B part quickly. We're going to do the B part since the B part is Karen Usmanov. Okay, so we'll do the B part. Karamo, don't worry. In 20 minutes maximum, we'll be done. The IRR is just the same as how to call it the NPV, except that you put you substitute the numbers in a formula that on the IRR formula. Yeah, we're going to do it quickly. Within 20 minutes, we should be done. Okay, so B. Right. So the B part, the average annual accounting profit will be what? We're going to add all these things. We're going to add the sum of these ones that are in green. Okay, we're going to add all of them. Okay, and we divide it by 4 years. Okay, is that clear? So we're going to add all this and we divide it by 4 years. Okay, but before we do that, let's add all of them, because at the moment What are they? What are they? They are cash flows. Okay, they are cash flows. We need to, for us to calculate the accounting rate of return, we need accounting profit. So we less depreciation from it. Less depreciation from it. Our depreciation will be what? 250,000. 250,000 is the total of the asset. Less 5,000 is the scrap value. So we have 245. So our average annual accounting profit will be this minus that. So that will be 286,000. Is that clear?
Yes.
Okay. Now, what will be our average investment? Our average investment. Our average investment will be 250,000 plus 5,000. 250,000 plus 5,000 divided by 2. That's 127. Now, what is our ARR? Our ARR will be this divided by that in percentage. Sorry. Is that correct? This is not our average. We should have averaged this. We should have averaged this, yeah? So this divided by 4. Okay, correct. So this will be our average. So I'm going to express all this into 2DP. Okay, so this one will be a percentage. Okay, so that's 56%. Our ARR is 56%. Is that clear? So we calculate our total annual accounting profit with less total depreciation. What we have, we average it by 4 years, and we take our average investment, which is the investment at start, less investment at the end. Okay, sorry, investment at start plus investment at end divided by 2. Okay, and then we take the two numbers, find the ARR. Is this clear? Are we together? Are we following?
Yes.
Oh.
Yes.
Karamo, are you fine?
Yes, I'm following.
Yes. Yes, sir, we are following you. Please.
Mr. Cole, tell madam to excuse you. What is he trying to chat there?
Yeah, he said, Jaranga, she want me to go home and I'm in the office. I said, no. I will Jaranga also.
Yes, tell them today is a marathon. You people are lucky. You're getting your learning in silver platter. If I tell you my story, you won't believe it. I suffered. So extending class up to 9, 10 is just a small one. We used to do longer than that. Come on. We used to work for long hours without sleeping and go to class, go back to work, and so on and so forth. So when you're studying here, you're definitely getting it on a silver platter. Okay, so that's the accounting rate of return for you. And the last part, like I said, is on the IRR. So we're going to quickly look at IRR, and we'll call it a day. We're going to quickly look at IRR, and we'll call it a day. Okay, so I'm just going to go back. Okay, so we've done this question, thank God. So the internal rate of return is another DCF technique, discounted cash flow technique, okay? It's the discount rate at which NPV is 0. Okay, so the IRR, unlike the NPV, is a relative measure. That means it's a percentage. Okay, and the decision rule is when we calculate our IRR in percentage, we will compare it to the target that the company accepts. Okay, so if it's more than that, then we advise that the project goes ahead. If it is less than that, we advise that the project does not go ahead. Okay, so IRR is simply that. And the calculations are also very, very simple and easy, just like the NPV. So quickly, we're going to look at this. So you have a question line. We're not going to answer it fully because we all know how to answer this. But I'm just going to show you how to go about it. I'm going to show you how to go about it. So it says calculate the IRR of the project below and complete the box at the end of the question. Okay, I've not got the box here, but anyway, we're supposed to calculate. So what you do when you are calculating an IRR is that you need two rates, two discount factor rates. Okay, you use the first one and you use the second one. So if you use the first one, if your NPV is positive, like for example, if we have used, let's say 16%, and you arrive at a positive NPV, now what should you do? You should go up, say by 2 or by 3 or by 4 or by 5 or even more, but let it not be more than 2, 3, 4, 5. Okay, so you use a discount factor that is greater than the discount factor you use to arrive at a positive NPV. If it is at least more than 2, you will get a present value that is negative. So in an NPV calculation, you need 2 present values because you are using 2 discount factors. One should be a positive one, and then the second one should be a negative one. Okay, so once you have a positive and a negative, then you substitute them in a formula. Okay, so we're going to look at this question just quickly. We are not going to answer everything. So in an investment like this, 4,000 and all the receipts are like this. So the first thing that we do, which is not mandatory, is just to allow you to have, how to call it, to have a starting rate. Okay, so if you do this, your starting rate will become easy. So what you do is you calculate your accounting rate of return. Okay, you calculate your accounting rate of return, just like we've calculated the accounting rate of return here. After getting your accounting rate of return, you take, how to call it, 75% of that. Okay, so let's say you calculate your accounting rate of return, you got, let's say, 20%. Okay, you get 20%. So that 20% multiplied by 2/3 or 75% will give you maybe around 14%. So that means your first rate should be 14%. So if you use 14%, you calculate your NPV, whatever you have. Okay, now add, let's say, another 2% to it. Okay, if you add 2%, if you calculate your present value, you should have a negative NPV. Then you use those two to calculate your IRR. Okay, so let's just demonstrate that quickly. Just 5 minutes, we're done. So I'm going to create an IRR. For us, we are all hustlers. We are used to all conditions, man. So if we had the opportunity,
You are not seeing the work in there.
Sorry?
The working, we are not seeing it.
Oh yes, we are not seeing it. Yes. I need to go right. Sorry about that. Let me just project that. So that tells you, even myself, I'm tired. Okay, can you see it now?
Yes.
Okay. So, like I said, if we calculate our ARR, right? I'm going to send this solution. I'm going to send the full solution to the forum. Don't worry, but I'm just going to show you because it's something that you already know how to do. So let's say we calculate our ARR, and our ARR turns out to be, say, 21%. Okay, so we're going to calculate 2/3 of this. Let's say 75% of this. So if we calculate 75% of this, let's say the force rate we come to, what that turns out to be. Let's see what that is going to be. That's 21 multiplied by 0.75, for example. This is just an estimate. You know, you don't have to do it, but it helps you to have a good starting point. Okay, let's say that's about 15.75, so we can round it up to 16%. Okay, we can round it up to 16%, or we can round it down to 14%. It doesn't matter. Okay, it's just an estimate. Now, if we calculate our present value using 14%, okay, using 14%, our NPV will be 83. So I'm going to use this 14%. Our NPV will be 83. Okay, that's $83. So we're going to add 2% to this 14% to have 16%, right? If we use it, when we calculate it, we should have minus 81. So our NPV will be minus 81. Okay, so two rates. This is what is required of you: 14% and 16%. So the first one should give you a higher NPV, whilst the second one should give you a negative NPV. Okay, and then now we substitute this in our formula, our IRR formula. Our IRR is equals to, so our IRR will be, our IRR formula will be what? It will be the rate or the lower DF. It will be the rate for the lower discount factor plus, bracket opens, our present value of lower DF, present value of lower DF divided by, okay, in brackets, present value of lower DF again. It looks big, but it does not, it's not difficult at all. Okay, so present value of lower DF divided by present value of lower DF plus present value of higher DF. Okay, present value of higher DF. Okay, then all that multiplied by the difference. So all that multiplied by the difference of the higher DF less the lower DF. Okay. So we're going to do this quickly. So what is the rate in this question? What is the rate of the lower DF? What's the rate of the lower DF?
It's 14%.
14%. Excellent. So it's going to be 14%. We say equals 14%. Okay. I'm just going to do the 14% here. So that will be 14%. Okay. So now we're going to calculate the present value of the lower DF. So I'll open the bracket. What's the present value of the lower DF? The present value of the 14% is 83, isn't it? Okay, it's 83, isn't it?
Yes.
Okay, so 83 divided by bracket opens. Okay, the present value of the lower DF again, that is this still same 83. Okay, plus usually the sign of the present value of the higher DF, which is negative, is ignored. So the negative is ignored according to the function. So you say plus 81, bracket closes. Okay. So 83 divided by 83 plus 81. We just do the equals. Okay. So is that clear? Right. So 83, which is the PV of the lower DF, divided by the PV of the lower DF plus the PV of the higher DF. Okay, and then the last part is that one will also be a percentage. Okay, that will be a percentage. That's the difference between the higher DF and the lower DF. Okay, so the higher DF is 16 and the lower DF is 14.
Mm-hmm.
Okay, so that's 16 minus, let's just say equals 16 minus 14. Okay, so that's 2%. Right. So is this plus this multiplied by that? Okay, so we can do our formula here. We say equals this plus bracket opens this multiplied by that. Bracket closes empty. Okay? So we have our IRR as 15%. Okay. So this is it. Okay. Any questions, please? This is where we're going to draw the curtain. So IRR is that simple. You calculate your present value using a lower rate. So if it gives you a positive number, now you add, let's say 2 or 3 or 4 or 5 to the rate, because the higher the rate, the lower the present value. So 14%, you add 2, or it can even be 17 or 18. The IRR will still come to the same. Okay, so you have 16. Once you calculate your NPV the same way with the same numbers, you'll have a negative of 81, and then now you use this function to plug the PVs of this lower and the upper, and then their rates. You'll have your IRR of 15%. Is this understood, class? Hello?
It's a long process. We need to go over it again, but no problem. I think
Yes. Yeah, please go over it. Go over it by playing the video again. And at your free time also, in case you cannot understand, feel free to contact me anytime. I think I will be able to help, inshallah. Okay? But if you don't have any question, I think we're going to wrap up here. We're going to stop here. And I'm really, really sorry to keep you this long. I'm really, really sorry to keep you this long because I definitely want us to finish so that we can take our exams. Karamo, so on, how to call it, I want to apologize to all of you, through you, for making this class too long. Myself, I'm tired, but what can we do? We have to do the work. Okay, is that okay?
Yes, and another thing, Mr. Fana.
Yes, sir.
From our group, some people are suggesting we move the exams to on the 2nd of the next month.
No, we are not moving. We are going to agree as we have stated. We are not going to move anything, because the thing is there is a potential. I don't want to mention it actually, but you know there is a strike that is cooking. So if that comes, it's going to delay you further. You know, so definitely we cannot move. Okay.
Okay, and another thing is, we would like you to send this video earlier so that we can revise it.
Inshallah, tomorrow. Inshallah, yeah. I'll send it tomorrow. Inshallah, I'll send it.
It was a long class, and you cannot calculate everything at once. Yeah.
Very long, yes. But if you watch the videos, you'll be fine. Inshallah, Karamo. Don't worry. And I'm here as well. Inshallah. So I don't mind. I can, you know, I can be of any help at, you know, at personal level. Okay. But I really want to make sure that I finish everything.
Okay.
Yes, sir. So
yeah, so about the exams, you know, do we need to widen our scope, like reading? Do we need to look at extra materials? All your materials are okay.
No. You don't need to get. I think the notes I've given you are adequate enough. But if you can lay hands on exam questions, like professional exam questions or so, yes, you can practice them. But as far as the material for reading is concerned, I've given you more than enough. Okay.
Okay, thank you.
Okay, so this is our final class. I don't know. I don't have any way of sending a questionnaire to assess what the class has gone and so on and so forth. But I just want your honest opinion. How was it overall? Did you learn anything? Did you enjoy anything? Is there anything that needs to be done later that we need to improve on and stuff like that? What's your perception? Just 2 minutes before we wrap up.
Mr. Fofana.
Yes, sir.
Really, your lecture is very, effective. Especially the introduction of the Google Sheet. It's one of its ever seen in the University of the Gambia so far, because this is my, this is my last semester.
Okay.
But anyway, this one, keep it up, honestly. And also you are someone like you give in a practical situation, and anybody who wanted to learn obviously will understand. Even if you don't want to learn, but like these things that you are introducing will interest you, that honestly you must get something from out of it.
Okay, I'm happy to hear that. Thank you.
And I would like, in fact, so that you can continue giving us like the lecture on Excel, because this one is very important, especially for me. It's every day that I use in our workplace. Every day I work. Yes.
Okay. Excellent. Okay.
to give lectures to other people so that it will not die out, please.
Okay. Inshallah, like I said, we can, through your class rep, Karamo, we can organize one day training. On Saturday, I was at the campus. I took about, I think, 40-something students. They were part of the debating association or whatever. A mixture of accountancy students, psychology students, mathematics students, and so on. So many. So, of course, we can do the same thing, especially for my own students. Yeah. So we could organize one later on, maybe after all the exams and stuff like that, inshallah. Okay? Okay.
Yes.
Any more remarks before we wrap up?
Yeah, Mr. Vona.
Yes, Mr. Kaur.
Okay, I just want to say we appreciate it very much, especially the working class, because really the use of the Google Sheet is going to help us. Like Usman said, we are using it every day, so it helps us to improve, I'm sure. And we are grateful that you introduced this, and I hope you keep it up also for the upcoming classes, really, because it's very important. Like you said also, we would like to have an extra, session where we at least can, go into details on a lot of things. That would be very important, really.
Inshallah.
Also, on a final note, the exam questions don't make it very hard, huh?
I like that.
It has been a good session, and thank you very much, really.
Yeah, no, but rest assured, the exams will definitely be, they will be moderate. I won't tell you that they will be easy. To be honest, they will not be easy, but then they will not be difficult also. And whatever comes there will be questions that we have done in class, inshallah. So I think what is important is for the rest of the 2 weeks that remains, try to practice, try to, watch the videos in case you don't understand any of the areas we have covered, okay? And I'm 100% sure that you'll make it in exams, inshallah. Okay. Karamo, any final remarks?
Yeah, Mr. Wafala,
yes.
First of all, I want to say thank you, and thank you for all the time we spent with you. You really did a lot for us because, for example, like Mr. Cole said, really working class, we definitely enjoy your lectures and it helps us a lot. Most of the time, the things that you are giving us are the ones we are really seeing in our workplaces. So that's definitely a big plus for us. Yeah, we want to thank you, and we want to also you to also keep the trend as it is. Yeah. Thank you so much.
Thanks. Thank you so much. Basin has been very, very active in my class as well. Basin, anything? Or the president's word should be the last one, yeah? Madeline and so on and so forth. They've always been, among the ladies, the Fainkes, Madeline and Basin have been very, very active during our classes. So, Karamo, on behalf of on behalf of myself, I like to thank you. I like to thank you all for having me for all this time. And to be honest, I'm really sorry that the class kept dragging. The main reason is I don't want to just come lecture you and then half-bake you, give you exams, and give you series of A's without you understanding. That has never been my style. I've been lecturing at the UTG, I think since around 2011, 2012. Of course, there is not a single time that I conduct my exams on time. Well, it's all not because I'm slow in presenting, but I like to go extra mile because this paper that I take, management accounting, is a core paper for accountancy students, and you need to understand it, and you need to understand it well. That's why I go extra. I try to inject a lot of life into it. I try to put it into practice so that even those that are not working, if they go out to work, you know, they will definitely have a very good start. They will have had some experience, especially with the use of spreadsheets and stuff like that. So thanks so much, and have a pleasant night. And please feel free to contact me at any point in time if you need explanation of anything, or if you need any other thing. And of course, I'm available. I provide lots of trainings, not only on spreadsheet, but on other areas as well. So tomorrow, I might meet you again at your workplaces. And of course, I pray that for those that are not working, that you have good job that is going to benefit you and your family. So thank you all, and assalamu alaikum.
Thank you.
Thank you so much.
Thank you.
Thank you, Mr. Foster.